Welcome to Get Yourself Optimized. I'm your host, Stefan Spencer, and today we have Adam Lean with us. Adam is the president of the CFO Project. Adam and his team helps improve the profitability of small businesses. They give their clients a CFO who helps them understand their financials and use them to make better decisions. He also has a podcast. Funny enough, it's named the CFO Project. And welcome to the show, Adam.
Hey, I'm excited to be here. Thank you for having me.
Yeah, well, thank you for doing this. I've heard great things about your podcast and your business. We're in a mastermind together called JVMM, and I just had to have you on the show.
Yeah.
So thanks for joining.
Oh, I'm excited.
So this is a problem that I bet a lot of our listeners who have even just really small businesses, maybe even just like a side hustle, where they're claiming some of their home as an office and running some expenses just to have a small kind of side gig. Numbers and figuring out all the different financials and keeping tabs on all those numbers can be a real struggle for many of us, me included. I delegate everything I possibly can, including from the number standpoint, including even my personal finances. I can't remember the last time I logged into my online banking personally, so I don't know what kind of account balances I have for my personal accounts or my business accounts. And so my bookkeeper tells me that I'm the client of hers that has the most stuff that I delegate to her, and I really like it that way because it gives me a headache every time I have to look at these spreadsheets, cash flow projections, all that sort of stuff. I know it's important, and yet it doesn't spark joy to use a term from the Marie Kondo kind of tidying up kind of world. So what kind of advice would you give me and others who are in a similar boat?
Well, the good news is that you're not alone. Most business owners don't want to look at the numbers because it's not what they're great at. That's not what most business owners got into business to do. Most business owners started a business or bought a business because they're an expert at their craft, whatever trade they're in or the craft they're in. That's what they want to do. Yeah. They're great at the product or service delivery, and they're great at sales and operations. They're not so great at the numbers, and they don't want to look at it. But here's the thing, though. It's totally fine to delegate, in my opinion. A lot of the accounting and finance. In fact, you probably should delegate your accounting and finance because you want it to be right. But the one thing that you can't delegate, and I tell business owners this all the time, is you have to understand your numbers, your core numbers. And the good news is there's not that many of them. I mean, less than 10. 10 numbers that you need to know every single month at the least. Even tracking them daily or weekly would be better. But even on a monthly basis, if you know these 10 numbers, and in some cases it's less than 10, if you know these numbers and understand them, then you can do the most important thing. You can improve them. And if you improve these numbers, the two main things that matter to every business of every size of any industry is profit and cash flow. You've got to have a profit, and you've got to turn as much of that profit into cash that you get to keep. Robert Kiyosaki, he wrote Rich Dad, Poor Dad.
Yep, love
he
that
said
book.
It doesn't matter how much you make, it matters how much you keep.
Right.
You can make $1 million in profit, but if you're not keeping it, if it's all going out the door, or you're not even seeing that in the form of cash, then what does that matter? The goal of your business should be to create cash, and that's a number. And so you have to understand your number. You have to understand certain numbers. You could delegate the rest.
Yeah, cash is king. And there's a distinguishing
Absolutely.
factor here that I didn't understand until I heard Keith Cunningham speak about it, and that there are three types of cash. There's O cash, operating cash. There's financing cash, and then there's investing cash. So
Yep.
O cash, operating cash, is king. That's what will keep you in business, or you'll die fast of a business heart attack if you run out of cash. So that was very enlightening to me, and I do ask my bookkeeper to give me a heads up. Cash is going to look tight at all, but yeah, the business is quite profitable, and so I don't normally have to pay that close of attention. That said, I know that if Peter Drucker is famous for saying what gets measured gets managed. So how am I supposed to manage something I'm not even tracking? Yeah.
Yeah. No, I'm glad you brought that up, actually, because that's the key. You have to understand your numbers, and then you have to know what to do about them in order to improve the cash flow and profit. And I want to touch on that, but let me first quickly touch on what you just said. There is three types of cash. If you think about it, a business can create cash in three different ways, and you mentioned the names, but the first way to create, or one way to create cash, is by taking on debt. Let's say you get a credit card, has a $5,000 balance. You have access to $5,000 in cash. You've created, in a sense, $5,000 in cash. The problem is, of course, you owe that money back. It's not yours to keep. The second way to create cash, if you will, is to get investors. So you can get, your in-laws to give you invest in your business $50,000. And that's great. You have $50,000 access to cash, but you have to give away a piece of your business, and you now have somebody else, helping you manage and tell you what to do with your business, because they're an owner, in a sense. I mean, you have to literally give away a piece of your business. The third way to create cash, of course, is you mentioned, you called it operating, or it is called operating, but how do you get cash from operations? You make a profit, and you have to have more sales, but more gross profit, more net profit. All of that turns into a profit. But then there's another hurdle that a lot of people don't really talk about, is that you have to turn that profit into cash. And here's an example. Actually, I met with a client last Tuesday, owns a large construction company, and they did in last month a little over $1 million in revenue. Sounds great. They had about I think their net profit for the month of January was around $300,000. Phenomenal, right? Mm-hmm. They had a loss, a cash flow loss of about $100,000. So they did not only not turn that $300,000 into cash, they in fact spent more than that on the business. So they had made a $300,000 profit, but they had their cash went down by $400,000 during the month. And I mean, there's a variety of reasons why in this business, but the fact remains, it doesn't matter that they did that much in profit. It matters how much you get to keep in the bank.
Yeah. So speaking of facts, like cash is a fact, whereas profit is a theory. Right?
Yeah, that's a good way to put it.
Yeah, I think that one's from Keith Cunningham as well. Yeah. So it's so important to have enough cash to cover your expenses, because if you don't, you have to go to your staff and say, I don't have enough money to pay the payroll this week. And that is the beginning of the end, because they lose faith in you. They start looking for other jobs. The best people tend to leave first.
Yeah.
It gets ugly.
Yeah, I completely agree. And, it's not enough to turn the profit. It's not enough to make the cash. I mean, you've got to make a profit and you've got to turn that into cash. But the thing that trips up a lot of business owners is they don't know what their next steps are. They don't have a plan for doing that. They want to focus on the operations of the business, and they want to sell, and they want to focus on their craft. They don't really know. They might get certain reports from their bookkeeper or accountant, the income statement or the balance sheet, but they have no idea what to do with it. And therefore, because they have no idea what to do with it, they don't know what next steps they have to take to turn the profit into cash and to keep that cash. And so that's why I alluded to a few minutes ago that there's a certain numbers that if the business owner paid attention to these numbers, then they wouldn't have to worry about the P&L or the income statement. They wouldn't have to worry about the balance sheet. They'd be able to just focus on these 7 to 10 numbers. And then based on the performance of these 7 or 10 numbers, you then know exactly what to do to improve the profit and cash flow in the business.
All right. So we got to know what those 7 to 10 numbers are. What are they?
Yeah. So no, and of course these may vary based on your specific industry, but by and large, most small businesses have the same numbers.
Okay.
All right. And so, but before we actually dive into the 7 numbers, I want to explain what to do with these 7 numbers from a 50,000 foot view.
Okay.
You've got to essentially, for each of these 7 numbers, you've got to track where you were last year for these 7 numbers. And then you've got to track a budget, or what I call a target, for each of these 7 numbers.
Okay.
And then every single month, you must track where you actually are for each of these 7 numbers. And you got to do that monthly.
Okay. At least monthly.
At least monthly, yes.
Okay, got it.
And, ideally even earlier, earlier than that, maybe weekly, even daily. The problem with that, though, is a lot of these numbers depend on your books being done. And most businesses' books are done at least on a monthly basis. Most bookkeepers don't do weekly bookkeeping.
Yep.
Is it possible to pause? I'm sorry. I don't know if you hear this, my dog in the background. I'm so sorry. Let me get him in the backyard.
Okay, no problem.
I normally go to a co-working space to work, but I had this, I couldn't go today. I rent a space to do these recordings. So before we dive into these 7 numbers, let's first talk about what to do with these 7 numbers from a 50,000 foot view. For each of these 7 numbers, it's important for you to track where you were last year for each number, and then set a target or a budget or goals. I call it targets for each of these 7 numbers. And then every single month, track your actuals, where you actually are for each of these 7 numbers. Now, for each of these 7 numbers, you'll know, because you set targets, you'll know if that number is causing you to not hit your profit or cash goals. Okay. So everything going on in your business, you'll know based on one of these 7 numbers what's working and what's not working in your business. And then only until you know what's working and what's not working, then you'll be able to know what specific action steps to take. All right, make sense?
Makes total sense.
Yeah, so the 7 numbers, and again, some of these may vary based on your industry, but the first is leads. You've got to, in order to make a profit, of course, you have to make sales. In order to get sales, you need leads or potential clients. So if it's an e-commerce store, a lead could be a visitor to the website. If it's a traditional brick and mortar business, it could be phone calls coming in or people visiting the store. You have to have opportunities to do business. So you need to track leads. And by the way, for each of these numbers, I like to track them on a monthly basis. So how many, if it's March, how many leads did you get last March? What is your goal for the number of leads you want to get this month for this March? And then once March is over, track what did you actually do. And by the way, if you don't have these numbers for last year, then don't worry about it. Just start with setting a target. The reason why I like to do last year, find out what you did last year, is because that gives you a benchmark for setting more accurate targets for this year. So leads, number 1. And then the second is the percentage of leads that you turn into an actual paying client.
Okay.
So that's, in the online world, that's conversion rate, but that's the same with the offline world too. How many leads can you turn in? If you get 100 leads and you own a heating and air business and you if you get 75 jobs from those 100 leads, then you have a 75% conversion rate.
Got it.
So The third thing to measure is the percentage of past customers that buy again. So this is, also known as your retention rate. How many of your past customers can you retain to come back? So if you own a marketing agency, for instance, and you had 30 clients last month, what percentage of those 30 clients can you get to stay this month? Mm-hmm. It's a retention rate. But also, let's use our heating and air business as an example as well. Let's say that last year you serviced 500 customers. Well, you spent the time and money getting those 500 customers last year. Why not get them to come back and buy again? So what percentage of those 500 customers that bought last year are coming back this year?
Yep.
So your retention rate.
Yeah.
All of those three things add up to number of sales transactions. So a sales transaction, let's say that, you want to get 100 sales this month, 100 orders, if you will, this month. Well, how do you do that? Well, those three things: get more leads, turn those leads into paying customers at a higher rate, and then get more of your past customers to buy again. Those three things will help you get more orders or more jobs, or however you define a sales transaction. Mm-hmm. All right. So then we have orders. Then you have to, we started measuring the three things needed to get orders. So then the fourth thing to measure is the average dollar value of a sales transaction. How much is the average job or average order or average sales transaction worth? So if you have 100 orders this month, and each order is $10, then that means your revenue is $1,000, right? Mm-hmm. So orders times average order value equals your revenue. So in order to improve revenue, we now have four things to improve: leads, conversion rate, retention rate, and average order value.
Got it. Okay. So
most people like to set targets for revenue or budget for what revenue, but they have no idea if the revenue's how to influence the revenue next month. Well, those are four numbers to influence revenue. And if you set targets for each one of those four, you know why your revenue is off target. Most people say, I set a target for revenue for $100,000, but only did $80,000 in revenue this month. I have no idea why. Well, is it a lead? Are you not getting enough leads? Are you not turning them into clients at a higher rate? Are you not retaining past customers? Or are you not, is your average order value not high where it needs to be? Mm-hmm. Those are four very different things that require different skill sets. So you may not have, a leads problem. You may have the fact that you're not converting leads into a customer at a higher rate, but you don't know until you start tracking these things.
Yeah.
So so that's four. The fifth is once you make a sale, the fifth is keeping as much of that sale as possible in the form of profit, also known as gross profit. So if you own a pizza restaurant, you sell a pizza for $10, that's one sale at $10. Well, you want to keep as much of that $10 as possible, right? Well, that's your gross profit. $10 minus all the direct cost to make the pizza is, let's say that was $3, all the direct cost for the ingredients and all that. That means you've made a $7 gross profit.
Right. So that's subtracting out the cost of goods sold.
That's right.
But not all the overhead.
Usually. And in some, it really depends on the business, but in most cases, you want to subtract out the direct cost. And something's direct is if the key to knowing if something's direct or not is if you didn't make any sales that month, you wouldn't have any cost. So in other words, if you have to pay that employee to be there, regardless of how many pizzas you made, it's probably not a direct cost.
Yep.
But if you didn't use that dough because you didn't make any sales, then that would not be that would be the dough and the ingredients would be a direct cost. Mm-hmm. But of course, it varies depending on the industry. There's some businesses we've worked with where labor is included in direct costs because because they're such a large part of the sale.
Or if they're contracting everything out.
That's right, absolutely. But regardless, and this is the thing about accounting and finance, is that a lot of it is an art, not really a science. So as long as you stick with one method and just use that method consistently, it almost doesn't matter where it goes. At the end of the day, what's the most important is for you to understand your numbers. So the fifth number is gross profit percentage. This is a percentage of sales. So in our pizza example, they made $7. That's 70% gross profit. So in order to improve the profit of your business, you want to get that 70% as high as possible.
Okay.
And so the sixth number is net profit. So you take your sales minus your gross profit, or minus your cost of sales, gives you your gross profit. Then you have to subtract out all the overhead to run the business, like insurance, rent, marketing, things like that. That's just overhead. So of course you want to get that number as low as possible. And that leaves you your net profit. So that's number 6.
So you want to get your overhead as low as possible so that your net profit is as high as possible.
High as possible. That's right.
Got
exactly.
it. Okay. And this is also a percentage?
So I like to measure net profit as a dollar amount and a percentage amount.
Okay.
A dollar amount because you can't take percentages to the bank. You need to know how much you really measure, making in terms of net profit. But I like to measure a percentage. That way you can benchmark against yourself. You can measure yourself against last month and against last year. You can also measure yourself against other people in your industry. If, for example, the industry average, let's say you own an online store and the industry average is 2.5% net profit and you're doing 5% net profit, then you're doing well above the industry average, regardless of the dollar amount.
Mm-hmm. Okay. So those are two different numbers then, or do you just count them as one of the 7?
I count them as one of the 7. Okay. You just measure it as a percentage and as a dollar amount.
Got it. Okay.
And so that's number 6. Number 7, the 7th number, is the percentage of profit that you turn into cash. And it's literally just a percentage. So if you made $10,000 in net profit and you turned 100% of that $10,000 into cash in the bank that you get to keep, that you don't owe anybody else, that's yours.
Including the tax man?
Yes, okay. Absolutely.
Okay. Paying
the tax, paying everything needed to operate the business.
Okay.
Then that percentage, that's the 7th number. So you want to get that, of course, as high as possible. Let's say, for example, you did $10,000 in net profit and you only added $5,000 to the bank. Well, that means you turned 50% of your profit into cash, which is not good. I mean, you want to get it as close to 100% as possible. So the question is, why did you only get 50%?
Yeah, where'd that money go?
Yeah, now you know that's the problem. If you're making plenty of profit, but you're not seeing enough in the bank, then that's the problem. You need to figure out, you now know, you've identified that is the problem because it's below your target of 100%.
So what happens in those kinds of scenarios that causes a chunk of the profit to not go into cash?
Yeah, there's really 2 main culprits. I'll add a bonus number 3, but the first main culprit is what's called accounts receivable. So this is the amount of money that clients owe you. So for instance, let's say you own a plumbing business and you made $100,000 in sales last month, but you made $100,000 in sales, and after all your expenses, you've netted $20,000. Okay, so theoretically, you think you would have $20,000 added to your bank account. What if every single one of those $100,000 clients, those clients that you got $100,000 worth of sales from, what if not one paid you that month? You sent them an invoice and they all pay in 30 days or so. So during the month, you made $100,000 in sales. You kept 20,000 in profits. You have a $20,000 profit, but you have a accounts receivable. People owe you $100,000. So look what happened here. You spent $80,000 in expenses out of your pocket to pay your labor, to pay your rent, to pay your marketing expenses and your insurance. So you spent out the door $80,000. Plus, you have $100,000 that is not owed to you, that is owed to you that you don't have. So now you're upside down in cash. You spent money and you still haven't even collected the money. So this is why a lot of people say they're making money, but they're not really seeing it in their bank account.
Right. Well, what if they're a bunch of deadbeats who never pay, not just pay late, but not pay at all?
Yeah, I mean, well, that's even a bigger problem, because if that happens consistently, that means that you're doing a couple things, or you're not doing a couple things. You're not keeping track of who owes you money, and you're not going after the right type of people that pay on time. So in other words, if you have a client that has a history of not paying you, or paying you late, or worse, not paying you at all, then you have to know that and then never sell to them again.
Yeah.
I mean, you have to keep track of your accounts receivable. In QuickBooks, if you use QuickBooks, there's a report called it's literally called the accounts receivable, or AR, aging report.
Right.
I recommend that the business owners run that on a weekly basis. This is assuming that you have accounts receivable. If you're a retailer, you're probably not going to have accounts receivable. But if you're a service-based business, you probably will if you invoice clients. So accounts receivable is probably one of the largest culprits of why cash flow is tight. Another culprit is inventory. If you're a e-commerce or retailer or restaurant, you sell inventory, you have to buy. I mean, you have to spend money to get product on your shelves in order to resell it. So you're spending money before the customer pays you, in a sense. So let's say you spend $100,000 to stock your shelves or stock your warehouse. That's $100,000 that's gone from your bank account and is now tied up on a shelf somewhere. So you have to go in your warehouse and look at shelves and just picture piles of money there, because that's literally what it is. It's money that's on a shelf, not money in your bank account. Now, of course, you have to have inventory. You have to spend this money in order to buy, in order to make revenue or make sales.
Yeah. Unless you're a digital goods kind of business or service business.
Yeah. Yeah. Which is a fantastic, business model if you can make it work, or a drop shipping type business where you get paid by your customer before you have to spend it with your supplier. Of course, there's pros and cons to everything. But if you're consistently making bad purchasing decisions, then that means you're going to have so much inventory that's not worth anything on your shelves, that's not in your bank account. And that does two things. One, it's money that's not in your bank account that you can use to do more other things with, like marketing or hire more people to help. But second, that means you're not selling through that inventory, turning it into cash, and then going out and using that cash to buy more inventory. And that's why they call it an inventory turnover. You want as high of an inventory turnover as possible. You want to turn your product in your warehouse or on your shelf, turn as in sell it, as much as possible. You want a widget to come in, sit on your shelf for, let's say, a day. I mean, you sell that widget, you get cash because you sell that product, and you're making a profit on it, hopefully. So now you have cash and then some to go back and buy two widgets that you can turn sell and sell those two widgets. If you keep doing that, then you'll have a high inventory turnover. The problem with cash, if a business is experiencing cash problems and they have a lot of inventory, it probably is because they have a low turnover ratio, low turnover rate. They're selling. They have a bunch of inventory that's just not selling, and it's just sitting.
Collecting
it's
dust.
It's collecting dust. It's not in your bank account. Exactly.
Yeah.
Yeah, you got it.
Yeah, and similarly with these accounts receivables that are sitting collecting dust, nobody is paying those. You don't have a pit bull on your team who's harassing your client. Is like, where's my money? Like I've told my bookkeeper this. Like she has to be a pit bull. Treat this business, my business, as if it's her business, and if money's not coming in, like just imagine if that's happening to her. And yeah, that's sunk in. Still, sometimes we get issues where she lets things go a little too long. I got really burned last year. A client, a very large one, went out of business, and by the time they did, they were actually closed down by the SEC.
My goodness.
Yeah, yeah, horrible, horrible. All these wonderful people who were very skilled and good folks out of a job. Yeah,
it's
it's
frustrating.
just, it is ugly. But yeah, I was, well, let's just say it was a six-figure loss to me because my bookkeeper let this go so many months in arrears because they had such a stellar payment history in the past for 2 years.
Mm-hmm.
And yeah, so that I'm never getting that money. Company's
That's
out of
frustrating.
business. It's been liquidated and there's nothing left. So it's pretty horrible when that happens. And if it were her business, she wouldn't have let that happen.
Yeah.
It's just, yeah, it's frustrating and painful.
Yeah, it is. I sense your frustration. I've had similar issues with myself, and I definitely have clients that have experienced similar problems. Here's the problem, though, is that most bookkeepers, whether you employ them or they're an outsourced bookkeeper or accountant, they're getting paid to record what happened. That's it. They're not getting paid to help you strategize and help you grow your business. And so that's why I go back to what I said in the beginning. The business owner has got to understand just a few key numbers. That way, if they understand those few key numbers, then they could take steps to say, hey, this number is off compared to my target. Bookkeeper, tell me why. Or marketing manager, tell me why. Or operations person, tell me why. But it all starts with the business owner recognizing the problem. And the business owner is never going to recognize the problem if they're relying on complicated finance. And I'm an accountant. I can say these things: the complicated financial statements, the P&L, the balance sheet, statement of cash flows. To the average business owner, they're confusing. And if something's confusing, they're just not going to look at them. I mean, according to the Small Business Administration, half of all businesses never see their 5th birthday. I mean, 1 out of 2. I mean, that's crazy to think about it. But I guarantee you, all of those businesses, even the ones that went out of business, had bookkeepers and accountants. The key is the business owner understanding the key numbers.
Yeah. So you said there's 7 that are the key ones, but there are up to 10. What are those other 3 that sometimes are part of the business?
Well, it depends on the business. So if and by the way, anybody that's listening, I can give a copy of these 7 too. We could talk about how to do that later on in the episode, but
okay, but you got a free download.
They're not taking it. Yeah, I can actually. I don't have one right now, but I can make one.
You'll have one by the time this episode airs. Okay.
Because this is something that's so important for the business owners to understand. The key numbers. Remember earlier when I said that in order to get revenue, you've got to improve orders and you've got to improve average order value?
Yeah.
Well, revenue is what I call a lagging, or what's called not a lagging indicator. It tells you what happened. In order you need to know what to do to improve revenue. You need to know the metrics to improve revenue. So the 7 things that I gave you, the 7 numbers, are leading indicators. These are things that lead to a number. So those are, I call them drivers. So 7 drivers of numbers. There's other numbers that you need to know, but they're more lagging indicators. They're not going to help you as much figure out how to improve profit and cash flow in the future.
So it's like driving your car. It's very useful to have the rear view mirror, but you can't drive the car just using the rear view mirror.
Absolutely. Yeah, that's a great example. That's a great example. Um, yeah, and so these 7 numbers are the numbers that will tell you if how well you're going to do, how well you're going to perform profit wise next month.
Got it. Okay. So I thought like of a metric to add to that list just as you were talking. For me, for my business, I have clients that will engage me on a one-off project sometimes, like a SEO audit, and I need to keep those clients kind of warm and let them know I'm thinking about them and adding value, not just checking in, but adding value when I do. So some of those folks do reactivate, and that's different from retention. So if I have a ongoing monthly retainer-based engagement with a client and they're just month to month and they're happy, they're continuing for months or years even, then that's retention. So that's that third metric that you said of customers retained. But then I could take a past customer client from 3 years ago and reactivate them by keeping them, in the loop on algorithm updates and just giving them a heads up to certain things that I happen to see and just adding value. So yeah. I would want to keep those separate, those 2 metrics separate.
Yeah, absolutely. That's a very good point. Most businesses usually probably have one or the other. They either have a retention business model or they have a business model where they don't have recurring clients. But in many cases, you can do both. And so that's another layer of numbers to have. So you can have you could track the percentage of past clients who come back, and you could track the retention rate of reoccurring clients. If you have both, then track both. That's a very good point.
Yeah, there's another metric that I've been tracking that is very helpful for me determining which conferences to speak at, which masterminds to be a part of. Right at the moment, I'm in 5 different masterminds, which is a lot.
Yeah.
That's not even counting JVMM, because JVMM is virtual. We don't have to travel and take days out of our schedule to meet. But there are 5 other ones where I do have to do some travel, and that's potentially very expensive. Some of these masterminds are like $25,000 a year, and they're well worth it because my bookkeeper tracks all the different revenue sources which marketing weapons drove that revenue. So we can see that, oh my goodness, this particular conference that I've been speaking at 5 years in a row hasn't driven more than a few percent of my total revenue. Why am I still speaking at that show?
Yeah, absolutely. We for all of our clients, we track your marketing sources, and then we track how many leads and then how many actual jobs or sales transactions you get from each of those. So you could track the return on investment. Yeah, that's great that you do that. It's very, very important. And that all feeds into one of the first main driver, which is leads. Are you getting leads from those marketing sources? And are those leads turning into actual jobs?
Yeah. Yeah. And one distinction
super important.
that I made with this is, and by the way, this idea I got from Tom Kelly, who's one of my coaches. He's great. But the distinction I wanted to make was that if an event conference, mastermind, seminar, whatever, led to me meeting a joint venture partner or a valuable referral source. I'm not going to associate the referral source as that in this marketing weapons spreadsheet. I'm going to go back to which event caused me to meet this person so that I keep spending money going to that event because
Absolutely.
it generated that kind of a partner.
Yeah, absolutely.
Yeah.
I mean, I think if more businesses did things like that, they would be they would see more profits and more cash flow.
Yeah. Well, it's surprising that I didn't do this for as long as I did. I've been doing this now for several years now, like 3 years. I can't believe that for all those previous years, I didn't do this.
Yeah, I mean, you could see. I mean, you could see the benefit of just tracking, even if you're not tracking everything. And in many cases, tracking smaller amounts of things leads to better results because you're not overwhelmed with data. You're just tracking the most important things that matter. And if as long that's the power of tracking, because that helps you understand, and you won't make corrective decisions or decisions that will help you better your business unless you understand the data.
Yeah.
And this is a great way. These 7 numbers, these key numbers, are a great way for you to understand your business.
Yeah. There's a phrase called data-driven decision making. If it's a number that's not going to help you make a decision, what are you doing with that number? Why are you wasting your mental horsepower, your attention?
It's a vanity number.
Yeah.
Like, who cares? Like, I completely agree with you.
Right. So if I wanted to massively increase my revenue and just white label somebody else's services, but their services were so expensive that I made only a tiny bit of profit on it, on the very surface level of this vanity metric or revenue, it would look really good. I'd be doubling, tripling, quadrupling my revenue, whatever the number is. But the profit's not there to justify doing it.
Right. Absolutely.
It's not viable.
That's right. I mean, and that's why, number 6 and 7 of the numbers are profit and cash flow. You have to make a profit, and you have to turn that profit into cash. Most people focus on, most people focus on revenue because it sounds better. Oh, I'm $1 million business. I have a 6-figure business or 7-figure business. So who cares if you're only making $20,000 take home? Who cares?
Right.
Like the goal of your business should be to make as much money or cash that for you, the owner, that you get to keep.
Yeah.
I mean, what you do with that cash is up to you. You can give it all away to charity. It doesn't matter. The point is the success, the health of a business is measured by how much cash it creates.
Mm-hmm. Yeah. And that's a side effect of value creation. If you're not creating value, it's not a viable business, even if you're creating cash.
Oh, absolutely. Absolutely. Totally agree.
Yeah.
And there's people that have pushed back and say, well, I don't really care about making a profit as long as my employees are happy and whatnot, or I own a nonprofit and we don't make profit. It's like, no, you're confusing things. If you're not making a profit and you don't have cash flow, you don't have a business.
Yeah.
And therefore your employees lose their job. So if you want to make your employees happy, then why not give them a business that's going to be around for another 5-10 years, and there's growth potential and there's earnings potential, and maybe they can even invest in the company. Who knows? But and on the people that say, well, I own a nonprofit. Well, nonprofits, it's a misnomer, have to make a profit. They have to make more than they spend, because if what's left over gets to go back into your the thing that their mission, the delivery of your mission. If you're a nonprofit, the more money you make means you could do more good for people. So at the end of the day, whether you own a nonprofit or not, you have to make profit. In the nonprofit world, it's called a surplus. And and you have to turn that into cash that you get to keep. If you get $100,000 worth of donors that say they'll donate but never do, it doesn't matter that you made $100,000. You have to turn that into cash.
Yep. Yeah, and with a nonprofit, many of these are putting their financials, their tax returns online, so you can just see what all the numbers are.
Yeah, absolutely.
Yeah, I just happened to be looking yesterday. I was curious what Code for America was up to, and I was looking at their tax returns just to see
Yeah.
how much money they get in donations. It's a lot. They get a lot of money, many millions of dollars in donations. It's very impressive, and they're spending most of it, but not all of it. Right. So they do have some surplus so that they
Yeah.
have money for a rainy day. Yeah, makes total
Yeah,
sense.
absolutely.
Now, one thing about AR, accounts receivable, that is going to make a big difference for your business, if any business, is that if you really reduce the amount of time where your invoice is sitting collecting dust, and you go from, let's say, net 30 to 45 on average to a net 5 to 15, that's more cash for you and less requirements to get, let's say, a line of credit from your bank. And you may not even need a line of credit with your bank,
Yeah.
just by getting these turnaround times of payment lower. And one technique for this that is super clever, I learned from the king of influence, Dr. Robert Cialdini. This was at the Genius Network annual event. He gave a presentation and he shared this. I'll just give a little bit of a highlight about it. Somebody shared this data with him that they were sending postcards with their invoices, and it reduced the time of turnaround for the payment. So then this lady started personalizing the postcard, not just writing a note like, thank you and it's great having you as a client or customer, but she would she had this one client who was a notoriously late payer, like 6 months, crazy long time. And she looked up his interests, and he was interested in art. So she started sending art postcards, and the turnaround time drastically shifted. It would be like less than a month turnaround time. And then she did more digging, and she found out that he was really specifically interested in modern art. So she would change the postcard to modern art postcards, and she started getting paid right away as soon as the invoice was received. Isn't that clever? So there's a lot more to unpack about this, but I just wanted to share
Yeah.
this idea of standing out from all the other invoices that the client is receiving and making it personal to them, showing that you care. It doesn't have to be a physical thing like a postcard. It could be a Bonjoro little video
Right.
message that you email to the client along with the invoice. But just that's so smart. And
No, I love that
yeah,
story.
Dr. Cialdini, he's the
It
author of
sounds.
Influence and of Persuasion. He's incredible. I've had him on the show.
Oh
Definitely
wow,
listen
I'm gonna have to check them out.
to the episode. Yeah.
I mean, in that story that you told, I mean, it sounds like there's two things that are going on. One, the business owner was savvy enough to know who owes them money.
Right.
I can't tell you how many clients, how many business owners don't know who owes them money or for how long. So if you
Yeah.
run that
So
AR
they
aging or
knew who was the biggest account or biggest accounts, and then who were the most notoriously late payers of those big
absolutely.
accounts, to then personalize a strategy around collecting from that person.
And that's the second thing is making it personal because you get a statement or invoice in the mail. there's no relationship, there's no human interaction. But I guarantee you, if not that people should do this, but if that business owner literally got in their car and drove to that person's office and sat down with them, it would become very real and personal because there's a human behind this. And so they made it real, and they humanized this invoice to it's all about relationships.
Yeah, it is. People do business with people, not with faceless corporations. So if you can
absolutely.
show that human face, you're going to get a better result.
Absolutely.
Yeah, yeah.
Love it.
So we have a handful of minutes left. I want to make sure that we cover the plan once somebody is tracking these numbers, seeing that they have a problem with lead flow, or they have a problem with conversion, or with retention, or with a small AOV, or whatever the issue is. Now, what do they do? How do they formulate a plan, and how do they start embarking on these next steps that execute on the plan?
Yeah, that was a great question. So the the exercise that we talked about with tracking those 7 numbers, but keeping track of targets or goals for each of those 7 numbers, and then if you update the actuals every single month, you'll quickly be able to tell of the 7 numbers which ones are not working and which ones are working.
Mm-hmm.
So you may be fine. And for our clients, we create a scoreboard for them that includes these 7 numbers, and it's red, green, or yellow. If it's green, that means you're ahead of your target. If it's yellow, that means you're a little bit behind. If it's red, that means you're very behind. So you may have green in everything except for, let's say, gross profit. That may be in red. Well, then the business owner immediately knows, all right, of everything I could be doing, the gross profit's the one thing that is preventing me from hitting my profit target the most. So let's focus on gross profit. So now you zeroed in, you put the spotlight on gross profit, and then you've figured out how now that you know what the problem is, now you could take steps to fix the problem. You could dig deeper and figure out why gross profit was off for that month. You're now focused on gross profit rather than focused on leads or average order value or inventory, because those are all fine because you're tracking them. You know they're fine.
Yeah. I really like this approach of having a scoreboard with the red, green, and yellow. Reminds me of Mike Moran. He's an SEO who used to work at IBM. And so big company, you deal with a lot of different department heads and division heads and so forth. And he would, for his SEO side of the, he was in charge of SEO, and he would show how the different departments and divisions were doing in a monthly meeting. And he used that kind of a scoreboard with the red, green, and yellow. And he called this management by embarrassment. So eventually, a division head would say, like, I'm sick of having, being the red box in every meeting that Mike Moran does. Just fix it. They'd just be like sick of having to being called out or being highlighted with the red boxes because they weren't up to snuff in comparison to all the other divisions. So that was pretty clever. And that's just for the SEO kinds of metrics. That wasn't the profitability or AOVs or any of that sort of stuff. Yeah.
There's a book, Alan Mulally. He used to be the CEO of Ford, and he did something very similar with what you just described. He had all his direct reports, the key leaders of Ford. He gave them metrics that they were responsible for, and then every month or every time they met, he gave them a score of red, green, or yellow. But the way
what was the name of that book?
It's called. Honestly, I can't remember the name. I think it's called American Icon, I think. But it's it's written by Alan Mulally. I'm looking at my bookshelf. I can't find it. He was the CEO of Ford when they were going through that, when all the car manufacturers are going through that crisis in the 2000s.
Okay, so yes, that is the book is called American Icon. Okay. Alan Mulally and the Fight to Save Ford Motor Company.
Fantastic read.
Bryce Hoffman. Awesome. Okay. I'll include that in the show notes.
Yeah, fantastic read. But the reason why I came up with this is I've been working with business owners uh, for a while now. But then about 3 or 4 years ago, I could not figure out how to translate to a client how well they're doing. Like we would track these numbers, but it just wasn't clicking. Something wasn't clicking. And I happened to go on a cruise, and this cruise ship allowed you to view the bridge. So you could go and there was a window to the bridge. The bridge is where the captain and all the other officers sit to essentially drive the ship, manage the ship. So I went up to the bridge and I looked, and the captain literally had just 3 computer monitors in front of him. That was it. And each of the 3 monitors had just red, green, or yellow squares. Literally, that's it. And I asked somebody about it, and they said, "Oh, yeah, that's that controls everything from the propulsion system to the air conditioning in the cruise ship to the electrical to the toilet system." I mean, literally everything. And if something was off, the whoever was in charge of the ship at the time could quickly see what was going right and what was going wrong. And then what was going wrong, they'd be able to dive in deeper and figure that out. And then the light bulb went off. Like, well, that's what we need to a business owner to quickly see what's going right and what's going wrong, and then they'll be able to take steps to fix it. So that's why I came up with the scoreboard.
That's genius. That's genius. Yeah, so that's really smart. Really smart. Do you have a template or something that can give the listener an idea of what this looks like and kind of how it works?
Yeah, so actually I have if you go to the cfoproject.com/video, it literally is called How It Works.
Okay.
And I show you exactly I show, it's like a 20-minute video, but I show you the scoreboard. Give you all the numbers that you need to track. And you literally get the process. So you can create this scoreboard on an Excel spreadsheet, on a piece of paper, on a whiteboard. I would get started today tracking these things.
Yeah.
Yeah. So just the cfoproject.com/video.
Okay.
Right.
We'll include that link in the show notes as well. Great. Yeah, this is awesome. So this is a very straightforward, not overwhelming next action for our listener to take is to go watch that video and create their own version of the scoreboard, whether it's on a whiteboard or a flip chart or an Excel spreadsheet, Google Sheet, whatever, but to start tracking these things and putting the red, yellow, and green in to see if you're just very quickly visually doing a good job or not. I love it.
Yeah.
Very cool.
You got to improve profit and cash flow. In order to do that, you got to understand your numbers. And this is a simple way to understand your numbers.
Awesome. Okay. So we are at time. If we could recommend any additional resources that are some of your favorites, the American Icon book is a great example. Like one for me is The Great Game of Business by Jack Stack, which is all about open book management.
Yeah,
I love that. The Millionaire Next Door, I love that book because that's all about not trying to show off and keep up with the Joneses, but just put that money where it's going to multiply.
Yeah.
And so what are some of your favorite resources?
Oh man, there's several that I really like. There's a concept that I actually use with my clients called objectives and key results, OKRs.
Yes.
Which sounds complicated, but it's not. It's really fantastic. It's used by Google and a couple other large companies and thousands of smaller companies. But there's a book called Measure What Matters by John Doerr that explains this concept. It's fantastic. And he sits on the board of Google. I would highly recommend that. And if there's any business owner that just wants to get better at their financial acumen, not everybody does, and not everybody, and I'm not saying you absolutely need to. as long as you understand these 7 numbers. But if you do want to go deep, there's a book I'd recommend called Financial Intelligence for Entrepreneurs by Karen Bierman. That is very good as well.
Awesome.
Yeah, it's the simplest. And I graduated with an accounting degree, and I've read tons of finance and accounting books, but it's the simplest explanation of financials that I've come across.
Okay. Well, I'll also throw in another book, since I mentioned Keith Cunningham a couple of times in the interview. He's got a book called The Road Less Stupid. He's a funny guy and so smart, and I highly recommend that book too.
Yeah, that's funny. Actually, I just started reading it 2 weeks ago.
Okay. Cool.
Yeah, I'm reading 4 books right now, so I haven't finished it yet.
Yeah, I do that too. I'm listening to 4 right now and reading another one. I'm a quick start, if you know what Colby quick start. I'm a 9 for quick start. So
same here.
I got to be doing so many different things at once.
I feel your pain.
Yeah. And to counteract that, I'm also reading or listening to the book The One Thing, which is
I read that last year by Greg McEwen.
That one's by Gary Keller.
Gary Keller, yeah, I read that last year.
Keller Williams. Keller Williams Real Estate. Yeah.
That is a good book. I really like that. It's very similar to Essentialism by Greg McEwen.
Yeah.
Very similar.
I haven't read that one yet, but that one's on my list.
Yeah.
Cool. All right. So again, the CFOproject.com/video to watch the video, and your just main website is the CFOproject.com. If they wanted to learn more about you and potentially work with you, so you take on clients to just basically be their outsourced CFO, right? Fractional CFO, essentially.
Sort of, yeah. We make it super simple. We just have a 4-step process, and every month a CFO will meet with the business owner once a month and show them what's going right and what's going wrong and what to do about it. So that way the business owner can focus on what they do best, and then they have a CFO or chief financial officer looking at their business every single month to show them what's going right and what's going wrong. That way, the business owner can focus on just the few things needed to improve the profits of their business. And we create a custom scoreboard for you. We analyze it every single month, analyze your financials, the scoreboard, everything. And then we get on a call, we go through the scoreboard, and we show you, here's what's going right, here's what's going wrong, and here's your action plan. And we give them a custom action plan to do. And it's usually never more than 3 things. And that way the business owner stays on track to hit their profit. I mean, that's our mission. We want them, our goal is to help them hit their profit target.
Yeah, and cash target.
and cash target. You're right. You're absolutely right. And it works.
Yeah.
So yeah, the CFOproject.com.
Right. And you have a podcast too.
I do. Yeah. It's called P is for Profit. Feel free to check that out. Our goal is to make business and financial concepts seem simple and easy to understand.
Yeah, that's a cute name. I like it. All right, very good. So thank you so much, Adam. And listener, now you've got some very tangible, straightforward things that you can work on to create that scoreboard, to take all this complexity and boil it down to just 7 or so simple numbers that you track on a monthly basis or better. And we'll catch you on the next episode of Get Yourself Optimized. I'm your host, Stephan Spencer, signing off.